What's good, people? I wanted to make a quick video talk to you guys about what's the difference between residential and commercial real estate. All right. So this is a pretty good question. Here in America, at least, residential real estate is defined as anything that's 1 to 4 units. And commercial real estate is residential real estate above 4 units, so 5 plus, or if you have something that's not a residential unit. So if you have an office building, if you have a mixed use property, something like that, that gets considered commercial real estate. It's important to know the difference between the two because the two of them have very different buyer pools. Um, if you think about residential real estate, for instance, residential real estate is mainly dominated by home buyers and homeowners. So I'm not really trying to say normal people, but if you think about someone who works a 9 to 5, they take out a mortgage, they're buying a piece of residential property for the most part. They're buying a house for themselves to live in. Maybe they buy a duplex if they, a little fancy, they want a little pizzazz on it, you feel me? But for the most part, you know, if you're looking at a single family house, your buyer pool is a lot of home buyers and homeowners and families and those are the main people who buy single family homes. That's not to say that large companies and corporations and REITs and institutional investors and pension funds and all that stuff, like, that's not to say that they don't invest in single family homes and in residential real estate as well. But the home buyer, the wife and husband or whatever, they're gonna be the main, at least here in America, they're the main buyers of residential real estate. All right, and you can see this just through a lot of the programs that are offered. A lot of loan programs, a lot of the government-backed programs that are offered is to encourage people to buy homes for themselves. So residential real estate is it's a home you're competing against. When you think about, you're looking at a single family house, you're competing against people who are trying to live in that house. You know what I'm saying? Residential real estate's a little bit different. Sorry, commercial real estate. I just explained residential. Commercial real estate is a little bit different. All right. Commercial real estate, the main two buyers of commercial real estate are business owners and investors or developers. And so the people that you're competing with, they're different. That the buyer pool is different. The metrics that each of them use is different. So if you think about a residential property, a single family house, you're competing with, remember, people who are just trying to buy a house to live in. So there's a lot of there's a lot of emotional sway that happens in residential real estate because this is, for most people, the largest purchase that they'll ever make in their life, buying a house. And since they're living there, they're very emotionally invested in the entire process. So they're willing to bid a lot more than what someone else who has a different use case for the property would be willing to bid. Okay? So residential real estate is cool, but a lot of people, they want to move over to commercial real estate. They're like, yeah, I'll start off in residential and I'll move over into commercial. And that's kind of what I did. I started off, my first project technically was a commercial project, but my first property, mine, was residential. And I started in residential real estate and I moved over into commercial real estate. And I still fuck with residential real estate. There's nothing wrong with it. You feel me? But now that I've kind of dabbled in commercial real estate, like, I understand the differences between them. One of the main things you got to realize, right? Real estate is real estate at the end of the day, but the metrics that you're using are going to differ, or the metrics that you can use are going to differ based off of what it is that you're actually buying. So commercial property, the way it's evaluated or the way it's valued is different than residential real estate. Commercial real estate, for the most part, right, there's sales comparables, right, which is actually what residential real estate is based off of. Residential real estate prices are based off of comparable sales data. So if you have a 3-bedroom, 2-bath house in this part of town, what are other 3-bedroom, 2-bath houses of around this size and whatever in this part of town selling for, have sold for, or are currently on the market for? That's mainly how residential real estate is valued. Okay, commercial real estate, that's an aspect of it, right? But cap rate is kind of the bigger driver or force behind how you value commercial properties. Cap rate is your capitalization rate. It's pretty much it's a function of your net operating income and the value of the home. So 3 different numbers, and they're all functions of each other. You have net operating income, you have capitalization rate, and then you have the sales price or the value of the property. So if you divide the net operating income by the capitalization rate, then you'll end up at the sales price. Your net operating income is pretty much just that. It's what are you making operationally off of this property, just from a net basis. You take your gross revenues and then you subtract all of your operating expenses from the property. So you subtract your management, you subtract your maintenance. If you're paying utilities, you subtract taxes, insurance, everything. So say after you subtracted everything, you got $10,000 at the end of the year. All right. And we know that based off of, historical data, buildings in this area similar to this type have a 10 cap, right? So you take that $10,000, you divide it by 0.1, 10%, right? 10 cap is 10%, so 0.1 divided by 0.1, and you reach a building value of about $100,000. You could also do it where, that the building is making $10,000 a year, and you want to sell it for $100,000, and then you figure out that you're going to sell it at about a 10 cap. This is really important because this is how, when they're like, yo, the big boys playing commercial real estate, this is part of the reason why, all right? So when you're doing sales comparable analysis, what's mainly used in residential real estate, there's almost a limit. You're kind of at the mercy and whim of the market in terms of how you evaluate the price of your asset or of your building. But in commercial real estate, you have a lot more control because you control your net operating income. And small differences in your net operating income can have a large impact on the value of the building based off of the cap rate of the area. So I'll give you an example, all right? Say, you own a building, you increase the net operating income $100 a month, okay? Just $100 a month. So imagine you go in, and this is commercial real estate, so you got to think imagine you got a 5-unit or a 6-unit, whatever, apartment building. You raise everyone's rent on a 5-unit apartment building $20 a month. All right. So now you're making an extra $100 a month. Your expenses don't go up at all, whatever. You raising everyone's rent, what'd I say? $20 a month? Yeah, because 5 units, $20 a month, $100 a month. If you raise everyone's rent $20 a month, you're trading at a 6 cap, right? I said 10 earlier, but 10 is also, so cap rates. Let me finish this example before I go into it. And you're trading at a 6 cap. You raise rent an extra $100 a month. You just improved the value of your building by $20,000. $20,000. You just raised rent $100 a month in total. And you just made 20 grand. All right. Now, cap rates are directly proportional to the desirability, I guess you could say, of the property and asset class that you're dealing with. So, office buildings in this part of town are going to trade at around a certain cap rate. Multifamily in this part of town is going to trade at a certain cap rate. Mixed use properties in this part of town, retail in this part of town, whatever. Different asset classes have different cap rates that they generally trade at. So you kind of have to know what's happening in the market. You know, this building that I'm in right now, it's a mixed use property. Cap rate averages on this building about 6.5%, like in this area for this type of building. Since I've been here in the past 3 months, I've probably increased our net operating income $500 at least. I'm still in the process of increasing it as I work things out. But, using what I said earlier, that's, gosh, I need a calculator for that. Like, for real. I mean, I don't run these numbers regularly because they're not that important to me. But if, I'll explain why it is important. I mean, you guys should know if I'm increasing the value of a property, say $100,000, well, that's $100,000 of equity that I can tap into. So if I go ahead and pull out an appraisal and now they're like, hey, yeah, you're right. This building now is worth $100,000 more. And then I take that appraisal to the bank or to a lender. I'm like, here's the value of the building. This is what the appraisal said. Then they give me 75 or 80% of that as a first on the property. So, of which I can use that money to pay off whatever first loan I have on the property. If I have any seconds, you can pay those off. You can pocket the difference. You can use that money to invest it in something else. But like I said, imagine you increase the value $500 a month, $6,000 a year, and you're trading at a 6.5 cap rate. Well, that's $92,307 that you increase the value of the property. So commercial and residential real estate, at the end of the day, is real estate. So there's a lot of fundamental things that are going to stay consistent across. But you have to be really mindful of who's buying commercial real estate versus residential real estate, because that's who you're going to ultimately end up selling to as well. If you want to think about how quickly you can move a house, a single family house you can sell super quick compared to, a 20 unit apartment building, because your buyer pool is so much smaller. And that has advantages and disadvantages. If you're out there buying, you have less competition, but your competition is also more keen. You feel me? Residential and commercial real estate, a lot of people think of it like you start in one, you graduate to the other, but they really work in tandem. Commercial and residential real estate if you have both mixes in your portfolio, is good, because they both hedge against different things. You don't want to only have a bunch of retail properties and then we hit a recession and all your retailers are going out of business, or you don't necessarily want to hold on to just single family homes and you miss out on the economies of scales that are possible with commercial real estate in a cap rate scenario. So, or a cap rate metric, my bad. So that's pretty much the short of it, guys. This is real brief actually, just high level overview of what's the difference between commercial and residential real estate. So residential real estate, 1 to 4 units. You're mainly working with home buyers and homeowners. All right. Commercial real estate, anything more than 4 units or something completely different, like an office building, a retail building, a restaurant, whatever. And the buyer pool for that is mainly investors and developers, institutional funds and stuff like that. So just be mindful of each one. They're similar, but they have some few key differences. And you can make a lot of money in both. So it doesn't really matter. What really matters is that you just go buy some shit, yo. All right, yo. I'm out. Have a good one.